Good morning, Sir Clemens and friends. So today we are going to present about chapter 10, the foreign exchange market. Our group consists of me, Ella, Felice, Ivan, and Latifa. Next slide, please. The first we're going to talk in this chapter is the opening case, the Mexican peso, the Japanese yen, and the Pokemon Go. So if you don't know what Pokemon Go is, it's basically a Pokemon game by Nintendo. Whereas if you want to purchase something, you have to buy Pokecoins. Pokecoins can be obtained if you play the games or if we make a real purchase using real money. Here, the problem is because Mexicans purchased the Pokecoins, they needed to navigate the game in Mexican pesos, and the peso has been falling in value against the Japanese yen. Back in the early 2015, one Mexican peso could bought 8 Japanese yen, but by mid 2016, one peso was only worth about 5.5 Mexican yen. Most trades between the yen and the peso are converted through the US dollar rather than traded directly. This is because the US dollar is the world's most widely traded and liquid currency. It's easier to trade dollars for yen and dollars for pesos than it is to trade yen for peso. In addition to this, Nintendo, the fall in the value of the peso against the yen has created problems for the other Japanese firms. The price of these components has gone up when translated into peso, raising costs for their Mexican operations and making them less profitable. On the other hand, the weak peso has also boosted the demand for some Mexican products in Japan. For example, Japan imports a large quantity of frozen Mexican pork. The price has fallen when translated into yen and demand has surged. Next slide, please. Next, for the introduction of this chapter, the foreign exchange market is a market for converting the currency of one's country into another country. An exchange rate is simply the rate at which one currency is converted into another. For example, here, Toyota uses the foreign exchange market to convert the dollars it earned from selling cars in the United States into Japanese yen. Without the foreign exchange market, international trade and international investment on the scale that we see today would be impossible. Companies would have to resort to barter. The foreign exchange market is the lubricant that enables companies based in the countries that use different currency to trade with each other. We begin this chapter by looking at the function and the forms of the foreign exchange market. These include distinguish among spot exchange, forward exchange, and currency swaps, which we will later discuss. Then we will also consider the factors that determine exchange rates. We also look at how foreign trade is conducted when a country's currency cannot be exchanged for other currency. That is, when its currency is not convertible. The chapter closes with a discussion of these things in terms of their implication for business. Next slide, please. Next, the function of the foreign exchange market. So the function of foreign exchange market serves two main functions. The first one is to convert the currency of one country into another country. And the second one is to provide some insurance against foreign exchange risks. Next slide, please. So as I said before, one of the function of foreign exchange market is currency conversion. So each country has a currency in which the prices of goods and services are quoted. When a tourist change one currency to another, they are participating in the foreign exchange market. The exchange rate is the rate at which the market converts one currency into another. Tourists are minor participants in the foreign exchange market. Companies engaged in international trade and investment are the major one. International business have four main uses of foreign exchange market. The first one is the payment of a company receive for its export, then income it received from foreign investment, or the income it received from licensing agreement with foreign firms may be in foreign currencies. The second one, international business uses foreign exchange market when they must pay a foreign company for its product or services in its country currency. The third reason, an international business also uses foreign exchange market when they have spare cash that they wish to invest for short-term in money markets. And the last one is for currency speculation, which typically involve the short-term movement of funds from one currency to another in the hope of profiting from shift in exchange rates. Next slide, please. Insuring against foreign exchange risks. So the second function of foreign exchange market is to provide insurance against foreign exchange risks, which is the possibility that unpredicted changes in the future exchange rates will have adverse consequences for the firm. When a firm insures itself against foreign exchange risks, it is engaging in hedging. To explain how the market performs this function, we must first distinguish among spot exchange rates, forward exchange rates, and currency swaps, which we will discuss now. Next slide, please. Spot exchange rates. So it happened when two parties agree to exchange currency and execute the deal immediately. The transaction is referred to as spot exchange. Exchange rates governing such on-the-spot rate are referred to as spot exchange rates. The spot exchange rate is the rate at which a foreign exchange dealer converts one currency into another currency on a particular day. Thus, when, for example, when U.S. tourist in Edinburgh goes to a bank to convert her dollars into pounds, the exchange rate is the spot rate of our that day. Next is going to present by my friend.
The next one is forward exchange rate. It occurs when two parties agree to exchange currency and execute the deal at some specific date in the future. For some major currency, for example, like US dollar, forward exchange rates are quoted to for 30 days or 90 days or 180 days into the future. Changes in spot exchange rate can be problematic for an international business. For example, U.S. company imports high-end cameras from Japan. In 30 days, they have to pay yen to the Japanese supplier when the shipment arrives. Assume that U.S. need to pay 200,000 yen for each camera. The spot exchange rate is $1 equal to 120 yen, which means US pay $1,600, and if they sell it by $2,000, they get around $300 as profit. But what if at the time of the shipment arrive, the exchange rate depreciate? It depreciates from to $1 equal to 95 yen, which means the cost of the camera will be $2,000, which is more than it can sell the cameras for. So that's why I said that the changes in spot exchange rate can be problematic for an international business. So in order to overcome this, the two parties make a deal to secure profit for the importers. If we look back to the previous example, both US and Japan make a deal in spot exchange rate of $1 equal to 110 yen, which is guarantees the importer will pay no more than $1,800 for each camera and secure the profit. Next slide, please. Okay, next one is currency swaps. So it's a simultaneous purchase and sale of a given amount of foreign exchange in two different value dates. The transaction between international business and their bank, between banks, and between governments. So, for example, Apple buy their screen from Japan and also they sell their final products there. Apple needs to pay $1 million to Japan for the laptop screens today, Apple know in 90 days they will receive payments of 120 million yen from Japan for the finished laptop. Let's say that today's spot exchange rate is $1 equal to 120 yen, and 90 days forward would be equal to 110 yen. Apple sells 1 million to its bank in return for 120 million yen. Now Apple can pay its Japanese supplier. At the same time, Apple enters into a 90-day forward exchange deal with its bank for converting 120 million yen into dollars. Thus, in 90 days, Apple will receive 1.09 million because the yen is trading at a premium on the 90-day forward market. Apple ends up with more dollars than it started with. So the swap enables Apple to insure itself against foreign exchange risk. Apple knows today that the 100 million yen payment it will receive in 90 days will yield $1.09 million. Next slide, please. Next one is the nature of the foreign exchange market. The foreign exchange market is a global network of banks, brokers, foreign exchange dealers connected by an electronic communication system. The most important trading centers are, the first one is London, which consists of 37% of the activity, and the second one is New York, consists of 18% of the activity, and the next one is combined between Zurich, Tokyo, and Singapore, in between 5% and 6% of the activities. There are two features of the foreign exchange market. The first one is the market never sleeps. So, for example, like the three cities like London, Tokyo, and New York only shut down for 3 hours each day. And then the second one is the integration of the various trading centers. So it consists of high-speed internet linkage between trading centers and integration of the financial service, like there's no significant difference in exchange rates quoted in trading centers. And then the last one is the important role played by the US dollar. Okay. Next slide, please. And next one is economic theories of exchange rate determination. Exchange rates are determined by the demand and supply of one currency relative to demand and supply of another. If we understand how exchange rates are determined, we can forecast exchange rate movement. So future exchange rate movements influence export opportunities, the profitability of international trade and investment deals, and the price competitiveness of foreign imports. Okay, next slide, please. Okay, next one is for the prices and exchange rates. So the first one from this part is the law of one price. So it states that in competitive markets, free of transportation costs and barriers to trade, such as tariffs, identical products sold in different countries must sell for the same price when their price is expressed in the term of the same currency. Like, for example, if the exchange rate between the British pound and the dollar is one British pound equal to $2 to US dollar, a jacket that retails for $80 in New York should sell for 40 pounds in London. Next slide, please. Okay, next slide will be presented by Ivan.
This is the purchasing power parity. So PPP theory for short predicts that changes in relative prices lead to changes in exchange rates, suggesting that countries with high inflation rates will see their currency depreciate against those with lower inflation rates. So this is the formula. So P is the exchange rate equals to P is the price. So the example for this one is dollar over price for yen. So this is actually used. The index is calculated by converting Big Mac prices into dollars at current exchange rates and comparing them to the average prices in America. If the prices differ, it suggests the currency is either undervalued or overvalued against the dollar. For example, in January 2017, Big Mac prices indicated that the Chinese yuan was undervalued by 44%, while the Norwegian krona was overvalued by 12%. So then I also put this is the example from the book. So the dollar is $200 over 22,000 yen. So imagine there is no price inflation in the United States while prices in Japan are increasing by 10% at a year. At the beginning of the year, a basket of goods cost $200 in the US and 20,000 in Japan. 20,000 yen in Japan. So the dollar or yen exchange rate according to the PPP theory should be $1 equals to 100 yen. At the end of the year, the basket of goods still costs $200 in the United States, but it costs 22,000 yen in Japan. So the PPP theory predicts that the exchange rate should change as a result, more precisely by the end of the year. Thus, 1 yen is equals to 0.0091 or $1 is equal to 810 yen. Because of 10% price inflation, the Japanese yen has depreciated by 10% against the dollar. $1 will buy 10% more yen at the end of the year than at the beginning. So that's the example. Next slide, please. This is the money supply and price inflation. So as we all know, inflation is a monetary phenomenon. It occurs when the quantity of money in circulation rises faster than the stack of goods and services. That is, when the money supply increases faster than output increases rates. So for the simple definition is when the growth in a country's money supply is faster than the growth in its output, price inflation is fuel. And this is actually for the next slide. Price level is a hypothetical measure of overall prices for some set of goods and services in an economy, monetary union during a given interval, normalized relative to some base set. Typically, the general price level is approximated with a daily price index, normally the daily CPI. Next slide, please. So this is the graph, the picture. As you can see, the month, it starts with April 1984, the money supply billion of pesos. So this is the money supply in there at the time, and for the price level relative to 1982 average to 1 is still in 21.1. Then the exchange rate pesos to per dollar is 3,576. But then if you see it in the very bottom, 1985 on October, the money supply, there's a lot of it, 132,550, and the next one is there's a lot. So this means that you have to pay a lot of pesos just to get $1. Next slide, please. This is the empirical test of PPP theory. PPP theory suggests that exchange rates are determined by relative prices, with changes in relative prices leading to changes in exchange rates. There's two terms in here. The long-term accuracy is PPP theory tends to offer relatively accurate predictions in the long run. Whereas for the short-term limitations is that empirical evidence shows mixed results for short-term exchange rate movements, especially between developed nations with similar inflation rates. So for the factors contributing to puzzle is that purchasing power parity puzzle is the disconnect between relative inflation rates and exchange rate movements is known as the PPP puzzle. The factors contributing to it is the first one is transportation costs and trade barriers create price differentials. Then government interventions in trade weaken the link between price changes and exchange rates. The third one is dominance of multinational corporations hinders arbitrage. Then the fourth one is government's interventions in the foreign exchange market disrupt the link between price changes and exchange rates. Then the last one is psychological factors also influence exchange rate movements. Next slide, please. This is the interest rates and exchange rates. So this is from Fisher effect, but the first one is Fisher effect states. It states that a country's nominal interest rate, the I, is the sum of the required real rate of interest, the R, and the expected rate of the inflation over the period for which the funds are to be lent. So for the example, I put on a very simple example from the book. If Japan's real interest rate is 10% and the US is 6%, investor will borrow from the US and invest in Japan, raising the US real interest rate and lowering Japan's until they equalize. So they will borrow from US because the interest rate is lower, and then they will invest in Japan because the interest rate is higher. Then we have, this is the formula. The I equals to R plus the capital I. Then there's international Fisher effect of IFE for short. It states that for any two countries, the spot exchange rate should change in an equal amount but in the opposite direction to the difference in nominal interest rate between the two countries. So this is the formula. S is for spot exchange rate. So this formula is also equal to the interest rate. So the example is like the I from dollar, the interest rate from the US is 10%. Then we have the interest rate from Japan, it's 4%. So the total will be 10% minus 4%, it will be equal to 6%. Next slide, please. Then the next slide will be presented by my friend.
Okay, so next we're gonna talk about the psychology of investing and also the bandwagon effect that happens in a lot of investment firms and also people in general. So short-term exchange rates are more about what people will think will happen psychologically than just basic economic factors. This makes them much harder to predict than long-term trends because you don't really know what's gonna happen. Because so we seen discussions about PPP, the purchasing power parity, and also the Fisher effect. There are some evidence that suggests that they aren't great at predicting short-term movements. And also the investor psychology plays a big role in short-term fluctuations. So investors' expectations about future exchange rates can become self-fulfilling prophecy. So if they do a lot of things that might to prevent negative effects in the future, that negative effect might actually happen because of this. So for example, we had in the book is someone called George Soros. So Soros famously bet against the pound, British pound, by borrowing and selling it, expecting its values to drop. This action, along with others following his lead, which is the bandwagon effect, caused the pound to actually weaken, making his bet successful. And short term is hard to predict because the investor psychology is influenced by various factors, such as politics and also specific company decisions that are difficult to predict. Bandwagon effects can be triggered by unpredictable events as well, such as maybe the pandemic or something like that. So a real-world example from the book is the Southeast Asian currency crisis back in the 90s. There is like a domino effect of how one currency weakening can lead to others dropping due to investor behavior. It's not necessarily linked to strong economic reasons. So, yes, in short-term exchange rates are more about what people think will happen than what actually will, making them a forecasting nightmare. Next, we've discussed about exchange rate and also the formulas and what we need to know about it. So let's talk about the summary of it. Factors like monetary growth, inflation, and interest rates influence exchange rates, but for different time frames. So, for example, in long-term exchange rates, these can be somewhat predicted by looking at the differences in countries' monetary growth, inflation, and also interest rates. So, for example, if country A has a higher inflation rate than country B, this means that the currency of country A is likely to weaken over time compared to country B's currency. And we've also learned that short-term exchange rates is much harder to predict. So things like investor sentiment, sudden news events, and fads can all cause short-term fluctuations and exchange rates that are difficult to foresee. So what this means for businesses, especially the ones working internationally, is that when it comes to long-term investments or exports or imports, companies should consider factors like inflation and interest rates to get a sense of how exchange rates might affect their profitability. And for day-to-day transactions, companies in dealing in foreign exchange rate frequently just have to live with uncertainty. So that's the summary of exchange rates theories. Next, we have exchange rate forecasting. So, a company's need to predict future exchange rate variations raises the issue of whether it is worthwhile for the company to invest in exchange rate forecasting services to aid decision making. Is it worth it or is it not? There are two schools of thought that addresses this issue. So the first one is the efficient market school. So here, people think that forward rates predict future spot rates, but is it really perfect? If the predictions are they perfect? So this efficiency debate hinges on whether forward rates fully reflect all available information. If the market is efficient, forward rates should be unbiased predictors, with inaccuracies random and not persistently skewed. While early studies supported this, suggesting companies shouldn't invest in forecasting, recent research suggests that some inefficiencies with potential for better predictions using publicly available information. Whereas the other school of thought is called the inefficient market school. So in this one, people think that the foreign exchange market might be inefficient, meaning prices or exchange rates don't fully reflect all available information. So some experts argue it's not as efficient as the effective market hypothesis suggests, meaning that prices or exchange rates don't fully capture all available information. This could be a good thing for international business. If the market isn't perfectly efficient, Forward exchange rates, which lock in a future exchange price, might not be the best predictors of what the actual rate will be. So this opens the door for professional forecasting services that claim to be better at predicting future exchange rates. However, in reality, the past performance of these services isn't stellar. So they whiffed on major events like the 1997 Asian currency crisis and even the 2008 financial crisis. So while the foreign exchange market's efficiency might be debatable, relying on forecasts to navigate it comes with its own risks. So yes, the effectiveness of these services remains questionable. Next, we're going to talk about the approaches to forecasting because we did talk about the services that offers forecasting for businesses, but here are the approaches as to how you do it. So the first one, we have fundamental analysis. So fundamental analysis uses complex economic models to predict exchange rates, considering factors like money supply, inflation, interest rates, and balance of payments of countries. So while a trade deficit can put downward pressure on a currency, it ultimately depends on foreign demand for that currency, influenced by factors like interest rates and also inflations, like we've seen before with the example of the Pokemon Go game coins and so on. This highlights that the core determinants remain money supply, inflation, and interest rates. They're still the basic core determinants. The second one is about technical analysis. So it forecasts future prices based on historical price and volume data, ignoring economic fundamentals. This method relies on the idea that past market trends will continue, though many economists see it as akin to fortune telling due to the lack of theoretical backing. Despite the skepticism, technical analysis has grown in popularity nowadays. Next, we have currency convertibility. There are three types of convertibility for currency. The first one is freely. It can be convertible from inside the country to another country, and another country can also convert their currency to this country's money. But then there's also non-convertible one, which means that neither external and internal people can convert their money, these currency. And then there's also externally convertible. So people from outside the country can convert their money into the internal currency, but people in the country cannot do the opposite of it. So freely convertible currencies are essential for smooth international business. Restrictions like non-convertibility creates hurdles for foreign investment and trade. So when it comes to international commerce, not all currencies are created equal. So sometimes governments would restrict convertibility, and the reason why is number one, they want to protect foreign exchange reserves. So since a country needs reserves to pay for imports and debts, governments fear that a run on the reserves where everyone tries to convert their currency at once will deplete the reserve. And then there's also to prevent capital flight, which means that this is when people inside the country, they lose faith in the currency and then convert it to foreign currency. So the government fear that the value will drop or there will be a hyperinflation. And this can further weaken the currency. So the problem with non-convertible currencies is that it limits foreign investment because businesses are discouraged from investing in a country if they can't easily get the money out. And also there is counter trade, so businesses resort to barter-like agreements to exchange goods and services instead of using currency. This is less efficient and can limit trade options. However, the trend is nowadays is that many countries have moved towards freely convertible currencies and that counter trade is less common due to increased currency convertibility in many countries around the world. So, ideally, currencies should be freely convertible, but it cannot happen in some countries. So, limited convertibility may allow international corporations to withdraw their funds while making it difficult for domestic enterprises to invest overseas. In the worst case situation, a currency may not be convertible at all. So, as a workaround, people may engage in barter like deals, as I've said before. But yeah, the good news is that many countries are now moving towards more freely convertible currencies. So, international business transactions are much smoother now for businesses. That is all from our group for this chapter. Thank you for watching.